Hello traders, you're welcome to this video and you're welcome back to the Forex Geek channel. So in this particular video, we are going to be diving into one of the most crucial aspects of Forex trading, and that has to do with achieving results consistently. Okay, in as much as there is no strategy that guarantees profit, and when it comes to Forex trading, losses are part of the game. But if you know what you are doing, at least your profit ought to be more than your losses. All right. So in this video, we are going to be looking at strategies that can help you to record consistent results. Okay. If you are someone who is looking to stay steady in the ever fluctuating Forex markets, then this video is for you. Now, in Forex, it's easy to get caught up in quick wins, right? But consistency is what really leads to long-term success. So I'm just going to be breaking down some of the best strategies that experienced traders use to minimize risk, build discipline, and make steady progress over time. Please note that in as much as these strategies can help you make consistent results, it does not guarantee profit. Okay, it doesn't guarantee profit. All right, yes, because losses are part of the game and no strategy is foolproof. By the end of this video, you have actionable strategies you can start applying right away to get good results. Okay, and if you enjoy this content, please don't forget to hit the like button, subscribe, and turn on the notification bell so you don't miss any of my future videos. All right, let us get started. First, let us talk about why consistency is so important in Forex trading. Many traders, especially beginners, enter the Forex world looking for quick profits. And while it's possible to make fast gains, it's often unsustainable in the long run. Okay? So Forex markets are incredibly dynamic, and what works one day may not work the next. All right? That's why having a set of reliable strategies is essential. When you trade with consistency, you are not just focusing on a single winning trade. You are building a system that gives you steady long-term results. Now, consistency allows you to handle both wins and losses without the stress of huge fluctuations in your account balance. It also keeps you focused and reduces the emotional impact of market volatility, helping you trade more confidently over time. Now, one of the most popular ways to achieve consistent results in Forex is through trend following strategies. All right. Trend following is exactly what it sounds like. You are identifying the overall direction of the market. For example, we can see from here, this is a bullish trend. Basically, when you want to identify the direction of the trend, you have to just look out for the market making higher highs and higher lows, or making lower highs and lower lows. So in this example, we can see the market making higher highs and higher lows, giving us a bullish trend. Whereas in this case, we had the market making lower highs and lower lows. So we had a bearish trend here, right? And then we had a bullish trend here. Okay, so now when you have identified the trend, then you look for trades in the direction of the trend. So in a sell trend or in a bearish trend, you should be looking for sell opportunities. On the other hand, in a bullish trend or in a buy trend, you should be looking for buy opportunities. All right. For example, if you identify a strong uptrend, like what we found here, you look for buying opportunities during pullbacks. So when we had a pullback around here, this would have been a good opportunity to buy. When we had another pullback here, this would have been another good opportunity to buy. Here again, after this pullback, would have been a good opportunity to buy. Now, to use this strategy effectively, you would want to identify the trend on a higher time frame, okay? Like the 4-hour or the daily chart. As we can see, we are currently on the daily chart. Remember that the higher the time frame, the stronger the analysis, the stronger the trend, right? So when you find the trend on the higher time frame, chances are that the trend is going to be valid compared to when you find it on the smaller time frames, okay? So you will likely have a long-lasting trend on the higher time frames compared to such found on the smaller time frames. Now, let us talk about one of the most overlooked elements of consistent trading, and that is timing your entries and exits, okay? Even the best strategy can fail if your timing is off. All right, now when we are talking about trend following, I also just want to give an example, right? When you want to enter a trade. So now let's say in this bearish trend you are looking for a sell opportunity, right? Ideally you should be looking for a sell opportunity. So when you had a pullback, you'll be looking out for bearish candlestick patterns, right, to confirm the entry. Because when price gets to the resistance, the dynamic resistance, it does not necessarily mean that the price must reverse. Remember that breakouts do happen. Okay, so there is a chance that we could see a breakout. But since we are not sure yet if there's going to be a breakout or not, then you should be looking out for bearish candlestick patterns around the resistance zone. So when you find a bearish candlestick pattern, you can then enter a sell. For example, we can see that we had a bearish engulfing candlestick around here, right? So after this bearish engulfing, we could have decided to enter a sell right about here and set our stop loss above the resistance. Please don't set your stop loss within the channel, okay? Because we could still have price retrace back to the resistance. So set your stop loss above the resistance and then target the support for your take profit and you are good to go, right? And then for a bullish trend, when you find a bullish candlestick pattern, or when you find, okay, for example, we had a doji here, right? We had a doji, so we could have considered entering a buy right after the doji, and then set your stop loss below the support, and then your take profit can be at the resistance. All right, so that is it for entering and exiting your trades within the trend. All right, now it's important for you to note that markets are always changing, right? And what works during one condition might not be as effective during another. This is where adaptability becomes critical, right? Now, consistent traders don't rely on just one strategy or approach. They know how to adapt to different conditions, okay? For example, during trending markets, trend following strategies work well, but in ranging or sideways markets, you might not want to consider range trading strategies. So we have talked about a trend following strategy right now that is completely based on price action, right? Now let us look at another strategy that is range based. All right, let us talk about a range based strategy. Now basically a range based strategy only works well when the market is in a consolidation phase, right? Now, you have to know when a market is consolidating. Basically, a market is consolidating when you have price reversing within a particular zone. In fact, let us use this one above. Let us use this here, all right? When you have price constantly being rejected within a horizontal channel, all right? So we can see that within this channel, within this horizontal channel, we had price consistently being rejected, right? Bouncing off the resistance, coming down, bouncing off the support, going up. So now let us talk about this range-based strategy. For you to use this strategy, using price action solely. Now, the reason why we are focusing on price action for, these strategies that traders expect consistent results from is that indicators are lagging, all right? In as much as indicators can be really effective, but they follow price action, right? Indicators actually follow price action. So indicators can be used to confirm your signals, right? You can use indicators to confirm your entries, to confirm your exits, to confirm the signals that you get from chart patterns, from candlestick patterns, and all of that, right? So both for the trend following strategy and for the range bound strategy, you can use indicators like the moving averages or the stochastics or the MACD or any other indicator of your choice to confirm your signals, all right? But now for the range based strategy, what we have to be looking out for is the key levels, the key resistance level and the key support level, okay? So what you have to do is when price gets to the resistance, now this strategy has to be ensured when the market is ranging. Make sure you only use this strategy when the market is ranging, because this strategy can be quite risky. The reason is that you do not always wait for confirmations, right? Because if you wait for confirmation, your entry might be late. Your entry might be late, right? That is the reason why it must be a range bound strategy. It must be a range bound market. But the confidence in the strategy is that when the market is ranging, it is moving within a well-defined channel, right? A well-defined channel. So now, if we are to trade this range-bound market, once the price just gets to the resistance, we can just go ahead and enter a sell, right? And then you calculate some pips above the resistance, and then you set your stop loss, and then you target the nearest support for your take profit. But because this is a very, time-sensitive strategy, you have to also be watching out for when a possible reversal is about to happen, right? Because sometimes the price might not get to the support before it begins to reverse. As in this case, it didn't get to the resistance before it began to reverse. So when the price gets to the resistance, you enter a sell, you set your stop loss some pips above. For example, you can set your stop loss about 100 or let's just say if you are trading on the higher time frame, right? Because depending on the time frame you are trading on, but I will recommend the higher time frames, right? So if you're trading on the higher time frames, you can just set your stop loss about, let's say about 30 pips, right? Let's say about 30 pips above the resistance, right? And then for buy trade, for you can set your stop loss, let's say about 30 pips below the support, right? So or 50 pips, just to be on the safer side, right? And then when you notice a possible reversal candlestick pattern, for example, we had a doji here, do not wait for the price to get to the support anymore. Once you get a doji being formed, remember that a doji indicates a state of uncertainty in the market, right? So when you notice a doji being formed, you just exit your sell right away, okay? Do not wait for the price to get to the support. In the case of a bullish move, right? When you notice a doji, can we see a doji formed around here? Just exit your buy. Don't have to wait for the price to get to the resistance anymore, right? Because it could show that the sellers are entering the market. So this range-bound strategy is focused on price action solely, but you can also add on any other indicator of your choice, specifically momentum oscillators, because moving averages are not exactly the best to use in a range-bound market, right? Or for a range-bound strategy. So, but you can use oscillators like the stochastic oscillator to confirm your exits and entries for this range-bound strategy. All right. Now, it's also essential that you have a trading plan. All right. A trading plan is essentially your blueprint for each trade, okay, including when you enter, exit, and how much you are willing to risk. Right. This keeps your trading focused and helps you avoid making impulsive decisions. Now, your plan should outline your goals, risk tolerance, and specific setups you look for. All right. It should also include rules for when not to trade. For example, you might decide to avoid trading during times of high volatility or around major news events. Okay. So a disciplined trader knows when to sit out just as much as when to jump in. So stick to your plan, track your trades, and review your performance regularly. Consistency isn't just about strategy. It's also about consistently evaluating and improving your approach. Okay. And there you have it. These are two of the best strategies. Although there are a lot of strategies out there, there are a lot of strategies that many traders use to make good profits. But remember that no single strategy guarantees profit. All right. It doesn't matter the results of the past, because past performance does not guarantee future results. Okay. So, but with this trend following strategy and range bound strategy, you can be able to catch good moves in the market. All right. If you found this video helpful, please give it a thumbs up and don't forget to subscribe I'll be sharing more content to help you become a better, more consistent trader. Thanks for watching, and I'll see you in the next video.